Hey, my name is Bryan Nale. I'm a mortgage loan officer with Primis Mortgage. I want to tell you that I absolutely love being a member of the Spread the Positive Network. It's such a great mission and helps bring so much positivity to our community. It's truly a pleasure to be part of. There are a lot of ways to navigate financing a home, and in markets like this, having the advice of a trusted local professional is key to making sure you get the right advice for your specific circumstances. Whether you're interested in the purchase of a new home, second home, or have a need for a refinance, I'd love to earn your trust. If I can help you nail your mortgage, call me at 615-243-3976 or visit nailyourmortgage.com.
Primis Mortgage is a subsidiary of Primis Bank, a member FDIC. Equal housing opportunity. As always, all loans are subject to approval. Primis Mortgage, NMLS number 1894879.
it's always going to fluctuate. But as far as oh, your wish has been granted, Hammond. Granted.
He is married. Oh my gosh. Man, I know. I thought I might be underdressed too, and I was thinking I should try to go home and put on a suit.
No,
Because I was like, Ronnie's going to be wearing a suit for sure.
what's up, bud?
I did have a suit on before I had this dress on, so.
Yeah. You're going live, right? Okay. Oh, we have? Oh, okay. How long? You gonna chop some of it off? Okay. Right. All right, Nale, let's do this. You have a good workout?
Man, it killed me. It
Yeah?
should kill you there.
It's good.
I worked out this morning and then they killed me this afternoon.
Good for you.
Oh, it's on.
Yeah. Need more sleep.
Hey, the lightwood stools got back anyway.
Ronnie, you need a beer?
Mostly water, I would say.
All right, are we ready? Outstanding. Hey, welcome back to round 2 of So What the Heck Happened in the Market. We did this January 4th, 5th. No,
It was the day of the
Ninth.
national championship.
January 9th. That's what it was. January 9th. Was it really? Oh, that was really poor planning, wasn't it? Oh, sorry. January 9th. And we made lots of predictions. We had lots of what we think is happening, what we think is going to happen. And so we got the idea of, well, let's follow up, see if we were right. So a lot of the same questions from last time. Really? There's always
There's
one.
always one in the group.
Always one. So lots of the same questions, and then we're just kind of, here's what we said, here's what actually happened. So one thing I know about all three of you guys is that if you said something incorrectly, you will own it, and you'll say, well, this is why I think this happened. Yeah, Ronnie's like, well, maybe you don't know that about me. But anyway.
I remember what I said.
So lots of good stuff. We've got some folks that are brand new to our community. Welcome. Glad you guys are here. We've got some folks that are really old in our community. Looking at you, Brian Derryberry, and glad you're here as well. And Charles, of course. And anyway, so lots of bald. Have you noticed that?
I'm doing just fine.
There is a lot of bald out in this audience. That's outstanding. So if you're watching at home, Trent is behind the computer. So if you have questions, you can put them in the comments on there as well. All right, let's just jump in. How about it? So we'll introduce first. I've got Mr. Bryan Nale. If you want to pull the mic to you there.
Yeah. So, yeah, my name's
No, pull the mic.
pull it all the way. Take it out.
You can if you want.
I think we passed him around last time. That worked well. But Trent, how's this audio sound? Good.
Okay.
So my name's Bryan Nale. I'm a mortgage loan officer with Primis Mortgage. I've been doing mortgage lending specifically since 2017, but I've been a banker in this community well before that. And I'm excited to be here tonight.
My name is Ronnie Martin, and I am a ninja.
He's not wrong.
I'm just kidding.
And apparently a comedian.
Yeah, right. So my name's Ronnie Martin. I work at Pinnacle Bank. Primarily, I do commercial financing, residential some, and because there hasn't been much commercial financing going on in the last 6 to 9 months. But typically developments, hotel, motel, commercial space, industrial, just about anything except what Bryan does. So I don't do mortgages. So.
And when you have karate class, do you take your tie off and use that as your belt?
No, sir.
Okay, just curious.
I'm Bryan Hammond. I've been a real estate broker in this marketplace for 23 years, a company owner for 12 years, sold just over $760 million of residential real estate, and generally just consider myself a numbers nerd.
And Grant also happens to be the authority on short-term rental in Davidson County, which you don't come by easily or quickly because it is complicated. Yes, indeed. So, all right, so let's jump into some questions. The format for tonight, it's 6:16 right now. I plan to go through these questions relatively quickly and open the floor up for your questions and anybody that's at home, your questions as well, somewhere around the 7 o'clock hour. Sound good? Great. All right, so question number one. At the beginning of the year, we sat here and we said, hey, rates are high. They're up in the 7s. We think that by the end of the year, maybe we're going to see some relief on there. We had some different numbers predicted, but they were all significantly below 7, or at least to me, what I would consider significantly below. So the question is, why have rates not come back down? And where do you think they will be at the end of this year, now that we're 3 months away, 4 months away? And let's start with why haven't they come back down, and where do you think they'll be at the end of the year?
I think they teased us in February, and in February it looked like they were starting to kind of get in line with where we thought they should be. But then some inflation numbers came out, and the inflation has proved to be very stubborn. But that's the big headline, is that inflation is in jobs or keeping rates high. But really, to me, it's the lack of liquidity in investors and wanting to purchase mortgage-backed securities. And 2020, when the Fed said, hey, we'll buy all the mortgages, you don't have to worry about who you're going to sell them to, we'll take them. That's what really drove rates so low. And since that that big institutional investor has left the market, the mortgage business and the mortgage industry has struggled to find replacement buyers for mortgage-backed securities, and that's artificially propping mortgage rates up higher than they tend to have trended. So the question is that the new normal, or are we going to find those buyers of mortgage-backed securities to kind of give some relief and bring liquidity into the market?
I think, my 2 cents on that would be, I think it's a couple questions in there, but, I do think rates are going to continue to remain high for a period of time. That's an unpopular answer because it's not what anyone really wants to hear, quite frankly. The banks are struggling with that from the standpoint that it puts pressure on cost of funding, because there is the expectation that as I'm charging you 9% for something. If you've got money in the bank, well, you're not going to let me pay you 1% on the money. So there's pressure on the funding side as rates have moved up. But Bryan and I may be saying the same thing, but I'm going to say it differently. I think that consumer confidence has probably been the thing that has kept rates high, and you could tie that to inflation. You could tie it to prices, but I think consumer behavior, I'm one that believes, amongst all other factors, that consumer behavior drives more things than anything. And I think for some reason, people still feel good about the economy. I think for some reason, people are still spending money and buying things. And I think that creates some artificial stuff going on. And so I think if we stop doing that, rates will come down, because that whole concept is designed to either spur activity or slow activity. So the more activity we have, the longer, I think the more this thing will be drawn out. So sort of the same thing, but a little different twist.
Yeah, I looked at the consumer confidence index the other day, and it's at 98.2 or something, where 100 being the average. So consumer confidence is surprisingly high and has been driving up ever since the bottom of the pandemic. In terms of rates, I agree with Bryan that the institutional bond buyers have not been prioritizing mortgage-backed securities. They have been prioritizing government bonds. They've been prioritizing a larger than average corporate bond issue that happened a week ago. And so without that to prop up the mortgage-backed security marketplace, that discounts what they're willing to pay for it. and then drives the actual mortgage rate up to make them more attractive. So how long is it going to be up? It could be up for the rest of this year in the 7s. We may be another 3.5 months or so before we see any kind of relief there. And relief can really only come from 2 places. One, the Fed funds rate is dropped, which we don't see happening this calendar year. Or 2, there is some new entrant in the mortgage-backed security marketplace. And that could be a factor, or that could be a global superpower buying up our mortgage-backed securities because their particular economy is not doing so well. So it's hard to predict, but I would say we're in the low 7s for a little while.
You know, one of the things that I've heard multiple times, you guys kind of alluded to it at the beginning of the year, and I've heard it several times since then, is that in order for us to see relief on inflation as an economy, and this is super unpopular to say, we have to hurt a little bit. Yeah. And we haven't. And I remember a conversation you and I had, it's probably April or so, and they're like, okay, you know, these jobs numbers, we're going to get these jobs numbers, and that's going to be, you know, good news, but kind of bad news at the same time. And instead, the job numbers came in like they added 395,000 jobs or something nationwide, and rates went up instead of coming down. So back to your point about consumer confidence, if everybody still feels great about everything, then they're still willing to pay. You made a comment. I rewatched the last one. You made a comment about, I'm really mad about how much eggs cost. And they're still expensive. So, okay. Where should rates be? Pure opinion question. Where should residential 30-year good credit interest rates, where should they be?
This is like a philosophical question, but I mean, based on all the indicators, they should be at 6.1%, 180 basis points above the 10-year treasury. That's where they should be if everything else in the world was working the way that it used to work, but it doesn't do that anymore. So the philosophical answer is need to be somewhere in the equilibrium where your 20% of what you make goes to your housing costs and not more. Right now we're at 25%. So rates need to come down a little bit.
I don't have a better answer than that.
The last thing you said spurred an answer to me. Is it that the rates need to come down, or the prices of real estate need to come down? Because you can get to that 20% number either way. So to me, I think just a healthy number is that gives the Federal Reserve room to move when they need to in either direction would be somewhere in the mid 5s to mid 6s. And if we could get to that spot where we have some certainty and rates can just bounce between those numbers, that gives people confidence to go out and sell the house that they're in right now and buy another house without worried about getting trapped into a rate that they don't like on a long-term basis. So to me, I think that's probably where that is. But your answer, it was fantastic.
I mean, to give you some context, right now, 82% of all mortgage holders have a mortgage interest rate of less than 5%. 24% have a mortgage interest rate of less than 3%. So the rates are going to have to get a lot lower before you're willing to let go of your property at that mortgage rate.
Well, and if you think about it, at the same time, if you bought a house 3 years ago, you've also seen appreciation, depending on your submarket, anywhere from 80 to 100% or more in some places. So the thought of selling and then turning around and trying to buy something bigger or something better or whatever, it's almost an impossibility, you know? All right. So Ronnie, I have a question for you. You mentioned something, I'm going off script here. So,
Let's do it.
It's always dangerous when that happens. Interest rates are sitting in the 7s on residential. They're sitting probably 8 or 9 or so on the commercial side.
9% on the commercial side.
Yep. So why have my savings accounts rates not trended the same?
Yeah. So in any operating business, right, no matter what your operating business is, as your costs go up, one of the things you're trying to do is always balance the operating model that you have. So how much revenue do I have coming in? How much am I making on the business that I have versus expense control and cost control? So in the banking business, as rates are moving up on the loan side, Not all those rates are variable rates. Some of them are fixed, right? So some of the stuff I put on the books is 8.5%, 9% coupon stuff. But I still have lots of stuff on the books at 4.5%, 5%. So you get a blended rate on that. On the deposit side, for us to make money and this gets into, we don't have to talk about it, but the inverse relationship between bond prices and interest rates and the value of your bonds, the value of our assets as rates go up and we have stuff that was fixed at lower rates, the value of those assets goes down, right? Because what I'd really like to do is reprice them all at 9%. But I can't do that. And so there's always going to be a lag on the deposit piece on how quickly they follow rates up. So what I would tell you is there's room to negotiate on that with anybody, but nobody's going to necessarily call their customer base and say, hey, let me pay you more this month. Hey, let me pay you more this month. Hey, let me pay you more this month, because you're intentionally shrinking your margin as you do that.
Sure.
Right? So the game
But on the HELOC, they don't mind calling and telling you that the rate went up.
anything floating, it's going to go automatically, right? So if you have deposits that are tied to an index, they move up with you. If they're in a standard product, which most deposit products are a standard product, you reprice them when they mature if they're CDs. But we'll just call me. We'll help you out a little bit, man.
All right. Grant, you were mentioning when we were off of here, kind of the how pricing has not really reacted as we thought it might to this. So what has kept house prices where it is to the point where there's a decent chance that 2023 will actually see some appreciation? Standard wisdom would say if the market slows tremendously, which it has volume wise, then we should see prices come down, and it just hasn't. Why is that?
Yeah, when we did this last time, we had just gone through a November, December of 8 or 9% depreciation, right as the interest rates peaked at 7.5 the last time around. As I think all three of us predicted on this panel last time, it stabilized and started going back up in the spring as we returned back to our typical buying and selling season. One of the interesting things that is happening is that Rutherford County is down 3% year over year in price. The whole Nashville MSA, 9 counties that's being tracked, is up 7%. So there's actually a 10% spread in pricing. And oddly, it's the more expensive counties that are doing better than the less expensive counties, with one exception, Dixon County. Dixon County is up 14% year over year right now, which is unbelievable. Factors keeping prices high. Inventory is lower, not a lot lower. I think Rutherford County is only 6% lower year over year, but the resale inventory on the marketplace is stubborn. They don't want to sell for maybe what it takes to get that transaction done. And so they are sitting on the market longer and waiting it out. And eventually they have found their buyer. I think a year or two ago, we got very spoiled by how quickly a house could sell, forgetting that, in 2018-19, it took 60, 65 days to sell a house. Now, if it sits on the market for 65 days, we're all thinking it's stale or something's wrong with it. But we're back to this normalcy of where we were prior to the pandemic. And those sellers are typically getting what they want to get for the product, or close to it, hanging out there a little bit longer. So I would think that trend will continue, and that prices will be very stubborn to drop. A lot of that is the fact that if you're in your house for an interest rate of 3.5%, 4%, what are you going to go do to replace, unless you have to buy or have to sell, unless there's a death, divorce, or job loss, right? Those are the three things. The jobs market here has been very solid. We're not having mass layoffs. We're having here and there, but we have more aggregate hiring than we do firing at the moment. So I think we're going to continue in this very stubborn pattern while these interest rates are above 7%. The really interesting question is, at what interest rate do buyers return? I guess we'll save that for the next one.
Not only do buyers return, but your resale sellers feel good about jumping in, right? Because from my perspective, the resale sellers that I've had have been people that truly need to sell for one reason or another. And very few that are just like, oh, I think it's the right time to move. Because it's back to everything that we've been saying. I lost the next question. Okay, that's okay. You mentioned the resale sellers, and you also, in that same breath, basically said that overall inventory has dropped some, but not a lot. So what we have seen, and for the first time in maybe ever, we're seeing new construction inventory as a significantly larger chunk of the total available inventory. At one point, I think in Rutherford County, it hit 45% of the available inventory was new construction, which typically it cruises around 20 to 25%. Why is new construction still thriving? And Ronnie, how is it? Because you said in January that we're not lending on the commercial side of things. So how's that happening?
Yeah, I think, Bryan touched on this, but also, just the economics of where we are today. So for example, we've had this conversation about how are you motivated? Why, if 24% of people that have a mortgage are less than 3%, I think of what you said. Well, if the best rate I can get is 7+% on that, if you look at the math on that per $100,000, multiply it by 3, 4, 5, 6, $700,000, that's a lot of money. It's a whole lot of money in your monthly payment. So from a cash flow standpoint, a lot of people are saying, okay, well, maybe I can do that. Maybe I don't want to do that, but maybe I can do that. And the reason they would be motivated to do that is because they say, wow, I bought my house 7 years ago or 8 years ago, and so I have this much equity in it. Well, when you look at what you were getting, in my opinion, 6 or 7 years ago for what you paid for, even apples to apples, you're not getting as good of stuff today as you would have gotten 7 or 8 years ago or 10 years ago for that matter. And guess what? You're going to pay a whole lot more for it. So it's one of these things where you're saying, okay, great. Maybe I would like to be in a bigger house, but a bigger house costs, the economics don't really work out where I can get the bigger house. And if I do get the bigger house, it's really not as nice as the house I bought 6 or 7 or 8 years ago. And when I look at my payment's going to go up. Why would I do that? And so what that means is the new construction piece that's out there, the whole business, the whole economics of reselling a home to buy a new home, to your point, unless there's been one of those major 3 changes, now's not the right time, the right play, the smart play. This is not my opinion, although probably is my opinion. What everybody's saying is, let me just wait until something changes, right? Unless you're moving here, unless you have one of those 3 incidents happen, or unless you're making so much money, it doesn't matter. Or you think I'm going to have my house paid off in 5 years, it doesn't matter. That's why new construction is still being bountiful. But to the second part of that question of, if we're not lending, why is that still happening? And I think the answer is, I made a lot of comments last time about trusted advisors, knowing who you do business with, making sure that you're having thoughtful communication with those people that you trust to give you guidance and advice. Well, the builder relationships that we have, we want to keep those. We want to keep them post whatever it is we're going through. As interest rates improve, we want to keep those relationships. So, if somebody comes to me and says, hey, I want to build 10 spec houses right now, I'm like, do we have to build 10? Can we build 5? And they're like, sure, we'll build 5. That's probably smart, right? So then we build 5. And so we've been able to reduce our exposure by not building as much product. But as a result, there's a high percentage of that new construction product out there still. There's still people that we're going to lend to. So there's still a new product out there. And you got everybody else on the sidelines for all those reasons we've all talked about, just waiting to do something else.
Gotcha. Any other thoughts on that?
Good.
Yeah, there's also not just banks out there now, but there's equity funds that are lending on a very large scale. And it's not just 1 or 2 subdivisions per builder. Some of these equity funds have signed 2025 subdivision deals. And so with a bank's cost of money at 9%, maybe sometimes 9.5%, maybe an equity fund would give you 11.5%, charge you 2 points on the front end, but maybe the LTC is 80% instead of 65% or whatever the bank may be. And so you see a lot of these guys willing to do these equity fund deals because it's less capital up front, even though they're going to spend more money on the interest expense.
Does that make you nervous for them? Because I started in real estate in 2009, and there were several builders that had folded because they got over leveraged, and all of a sudden all these loans that they had done, they were trying to get in on the gravy train there, and they got caught. And I know that's why the banks are saying, no, we don't want to do that again. But yet there are builders that are willing to overextend. Thought in my mind, with their banking on, it's going to sell in a quick enough time that, because they probably got what, 6-month fuses on them, 1-year fuses maybe. Yeah. So how does that not make you nervous?
So a lot of builders get trapped into having to feed the beast. So they've built a business that has, 3 on-site managers, 2 bookkeepers, and they've got to continue to feed this beast, or they've got to let people go. And people are just hesitant to downsize their businesses based on the economics of what's happening in the real estate market. They think they can always build through it, that they'll just lower their margins a little bit, tighten their bootstraps, and we'll be good to go. And so that has happened, and there have been 2 or 3 builders that have already gone down, that are in the process of bankruptcy and handing the keys back. Typically right now, it's not the good operators. I mean, those guys were going to go down at some point. They robbed Peter to pay Paul, and they've been doing that for a long time. But if you put that out over a long enough horizon, it's going to catch a few of the good builders too. And so the question remains, how long do interest rates remain high? How long until banks are willing to be more real estate lenders? I know there's a big commercial debt load on several of the banks, and CMBS loans are not really available at the moment. And so when those come due, who takes the brunt of that? And so it seems like these equity funds are going to fill that void for a time, and that's going to put some builders at risk. Which I think last time you had asked, like, where are the best deals? And I said builders at the end of the month. And that was 100% true. And it's still true. The best deals are still those big national builders have got to hit their numbers. And man, you go the last 5 days, 3 days, or if you show up on the first day of the month, act like you're interested. By the end of the month, you've got 46 emails and calls and text messages from that on-site rep. That's the time to go and negotiate those deals.
It's like buying a new car.
I think Grant's exactly spot on about that. I mean, I talk to guys a lot, and when they get into sort of like a dating relationship, depending on how you view that, we're not going to commercially bank folks that are using private equity money. And part of the reason for that is you can't control it, right? You can't manage it. And so the commercial banking game is all about risk. We're a publicly traded company. We have an obligation to shareholders to make sure we're making good loans, and then we get our loans repaid. We have to be right 99% of the time. And so the kind of formula that Grant's talking about is where guys are saying, hey, these people are like family. This person's like family, or I've spent my whole career building this business. I'm not going to dismantle it. If I can just hang on for 12 or 18 months, we'll be past this, right? Well, I'm working through some things right now where Oak Hill, very nice place in Nashville, high-end luxury homes, 2019, 2020, new construction, 2.1 million, 6,000 square feet. When it took 18 months to go vertical and build it. 2022, reappraise, $3.8 million, just like that. Reappraise because it hasn't sold in 2023, $3.2 million. So you got this thing, this roller coaster that we're on, and the folks, some of these folks that I'm working with are saying, hey, if I can just last 12 or 18 more months, this will be over. Well, maybe.
We hope.
But you're not going to operate like that with our money. You can operate like that with your money.
Yeah.
And so you get into private equity money, and it's even, while it seems easy, they're even harder to deal with if something doesn't go exactly the way it's supposed to go, because there ain't no relationship with those folks. They will just take what you have.
Right. Let's shift that gear just a little bit. So one of the kind of rally cries in real estate right now is marry the house and date the rate. You hear that all the time, right? The rates are 7 point whatever, but that's temporary. So if you can afford it, find the house that you love and date the rate, and you can just refinance it. there are some definite pitfalls in that. And I know that there's been some things that have happened that have kind of actually sought to actively discourage that. Bryan, can you talk to some of that a little bit?
I remember the first time I heard that, I thought, what a gimmick. Like, that's like, that sounds like somebody that needs to make a sale or have a closing next month. And to anyone who said it, hey, no fault to you. I'm not calling anybody out.
I'm glad to hear you say that. I thought you were saying it's a great idea. So.
No,
it sounds like a gimmick, but I'm not calling you out.
But it's, golly, think about how many people were told that when rates had climbed from 3 to 5. And now they're sitting there with a 5% mortgage and their family's budget might be barely hanging on under the promise that they might be able to refinance that thing back to, maybe 4.
And instead it went to 7.
And instead now rates are 7. So the whole time going up, we never knew where rates were going to peak. So how could you tell somebody marry the house and date the rate when you don't know how long it might take to refinance the house? They may never get a chance to refinance the house because nobody, when we got to 5, thought that was the ceiling. Very few people did, at least. So I've never been a big fan of that catchphrase, but I do think that there eventually will be an opportunity. And I've kind of shifted now where I'm not going to go so far as to say marry the house, date the rate, but I think it's a great time to buy a house if you're a first-time home buyer. And I've helped more first-time home buyers this year than I was able to the last several years because there's just more opportunity for them to come to the market and have an offer accepted with an FHA loan or a THDA loan. And so it's giving people the opportunity to at least start. But I always want to make sure that I'm saying to these clients, hey, if you're getting a THDA loan and the rate's going to be 6.5, make sure you're comfortable with that number. Maybe you'll get a chance to refinance out of it. Maybe you won't. But if you're comfortable with this number, that's as good a time as you can hope to buy because you might be able to negotiate the seller to pay some of your closing costs for you. And I've had people get their earnest money back or portions of their earnest money back at the closing table because they're buying now. And I think that's great. I'm happy for them.
Well, and pent up demand being what it is, when the rates finally do come back down, we're going to see a flood back into the market. Grant, one of the things that you said kind of along those lines last time was you were talking about how essentially the institutional buyers out there, the big property management companies, H4Rs and those guys,
Yep.
they were stopped. They were doing nothing. Are they back? And if so, how are they operating? And
yeah, they're back in a different way now. So instead of going in and buying, 2 houses in a neighborhood or 6 houses in a neighborhood, or even the entire finished neighborhood, they're developing ground up.
Mm-hmm.
And so what you'll see now is these guys will bring inventory on the marketplace that didn't exist beforehand, whereas they were taking existing inventory off the market last time. So that will change the dynamic on how prices are either supported by them taking inventory off the market or how prices are not supported by them adding additional inventory that may not have existed in the marketplace. So Wall Street's got to use their money, right? They got to give it back to their investors or they got to use their money. So they had to figure out how to use it. And now they're doing it on ground up development.
Gotcha. And I've heard lots of, I think there's a couple of those developments here in Rutherford County. One of the things that I hear all kinds of different opinions about the institutional buyers, and again, this is your American Homes for Rent and Progress Residential and some of those guys. Will the houses that they bought, because they bought lots and lots and lots of houses in our MSA over the last 5, 6, 7 years. I've heard different theories. One is what happens when they decide to unload all of those houses and flood the market with inventory. My opinion is that won't happen. I'm more of the mindset that instead they're going to figure out a way to hold on to them, depreciate them, move them to another fund, depreciate them again, move them to another fund, depreciate them again, and that the houses that they acquired will never be in the market again as a resale. What are your thoughts on that?
That's you.
Yeah, so they do the same thing. Think of their houses like mortgages. So Bryan writes 15 mortgages. They get packaged up and sold off as mortgage-backed securities. Same thing for these Wall Street guys. They buy or build 100 houses. They securitize them, and then they sell off the income, the future income. They get more equity. They go and do more deals. They securitize. They sell it off. And a lot of times they'll sell it off within the company. So for the Progress Realty deal that's happening down the street here, it says Progress Realty Fund 16. And so they are building out their inventory in Fund 16. Once they stabilize it and they have an income, they'll securitize it based on that income, and they'll go sell it off to, whoever it might be. Might be BlackRock, might be another competitor, it might be a company, Fund 2, or it might be a company that they own, and they'll keep churning and churning and churning that and producing more and more cash so they can keep doing it. And that tidal wave eventually crashes. There's no pretty way to say that. The question is, does it crash at a time where the marketplace is eager and ready to absorb some inventory, or does it crash at a time where the marketplace is not ready to accept any new inventory? So I don't think it happens anytime in the near future, but eventually, a generation down the road, that could be the white whale that we've all been worried about.
Let's do this one. Bryan, with the rates being where they've been and staying quite a bit longer than I think most people hoped, at least at the beginning of the year, some of the mortgage lenders have gotten a little bit creative with some ways to make affordability happen. You mentioned THDA and FHA, of course. And we've seen offers with THDA, FHA way more this year than we did over the last 3 years. What are some of the things maybe within your bank or some of the others that folks are doing to help with affordability? Some of the programs that they're trying to offset some of that risk, some of those things.
So there's a couple things that just pop in my mind right away. And one of them is it kind of goes along with the marry the house and date the rate option. And that would be to have a free refinance program. And so you can get caught up in the language and the wording and everything, but like at Primis, we have a program called Bounce Back, where if you buy a home with us and you let us do the mortgage, as long as you make the first 6 payments on time, we'll come back in and we'll refinance that house for you down the road when the time is right. And we will waive our lender fees. We'll give you a voucher for the appraisal. You'll still have some title expenses. You'll still have a settlement services fee from the title company, but the lender fees are paid for by the bank. And so that's one option that I've seen. And we're certainly not the only bank around that's offering programs like that, but that encourages people to say, hey, look, if you're comfortable with the rate where it is, and you do want to go ahead and buy now because your life dictates it's time to buy a home, you can do that and have some confidence that when you are ready to refinance, that break-even window will be shortened by reduced fees on the refinance, reduced closing costs. I think Carolina Panthers might have just done something.
Our boy Trent over here watching it. He's one of 10 Carolina fans in the world. So.
And I'm a Saints fan, so our teams are battling tonight.
Bless y'all's hearts.
But another one is the 2-1 buy down programs. Those had been around for a long time, but it completely gone away because with rates in the 4s and the 3s, there's really not much of a need for a 2-1 buy down. As rates started to get into the high 5s and 6s, you saw more and more of that being thrown out into the market, and it can be a great option for somebody. To me, it's if the seller's willing to pay some closing costs for you and give you the money to buy the rate down, they're basically subsidizing the interest for the first 2 years, a portion of the interest. So you may start at 7.25, and so if that's the base rate for that first year, it's going to be 5.25. And that second year, after the first anniversary of owning the home, it goes to 6.25. And then if at some point in that window of time you're able to refinance, you've been able to enjoy the lower payment. And if you don't get that opportunity to refinance during the first 2 years, you're just back to where the rates would have been all along. It makes sense if the seller's paying for it. It doesn't make sense if you're tying up your own money in a 2-1 buy down. I'd rather see somebody do a permanent buy down, and you could even do a combination of both if you have the seller paying for the temporary buy down. But and whenever you refinance the house, let's say you're a year into it, the money's for the 2-1 buy down has been set aside in an escrow account, and you're going to get that money back. You can either apply it towards the principal on your refinance, or you can take that money back out in equity, and however you want to do it. So that's an opportunity to 2 opportunities right now, even at the higher rates, where you can kind of go into that with some confidence of having lower payments.
Yeah, and I'd point out that that's part of what is propping up the price right now too. So when we say Rutherford County is down 3%, Nashville's up 7%, that's not taking into account the fact that there could be tens of thousands of dollars of each transaction. They're going towards rate buy downs or closing costs or whatever it might be. So
Keeping the price up.
yeah, if you look at the actual net effective price, it's got to be lower, but there's no way to track that, unfortunately. And so all we've got is this price metric.
Yeah, that's a good point. All right, so here's a super popular, super fun question. We hear this all the time. First of all, there's no such thing as a national real estate market. So let's just say that. But that being said, is the Nashville MSA insulated versus other areas in the country? And if it is, then why is Nashville MSA still insulated? We've got one submarket that's 14% up. We're only 3% down, that kind of thing. What is it about our area?
I mean, I would say yes. I think the Nashville MSA in general has shown really tremendous resiliency compared to some other places. And so I think it's a game today very much of the pockets. I think that's a term that's more and more important than anywhere. There are pockets that are going to be great inside the MSA, and there are pockets that are not going to be great. As people have choices, it's still kind of a buyer's market, if you will, to a certain extent. And so I don't expect that we will see substantial price reduction, although I think that would be good. I don't think that we will see that. I think that the rate environment will continue to be high, probably throughout most of 2024. And, my basis for that is I feel pretty confident the Fed's going to raise rates again on Wednesday. And if they do that, it's highly unlikely that there's going to be enough economic data to justify a pullback quickly. There may be a period of time where it's flat. But I just think considering where overall we are, I think we have been very resilient. And, personally, this is just one of those things and we can disagree on, but I think the sooner we deal with the pain, the faster we can get back to good things. And the more prolonged all of this is, me personally, I think the more uncertain everything becomes. And so, I don't want people to suffer. I don't want folks to not have income and jobs and all that sort of thing. But I think to a certain extent, part of the reason this is drug out so long is because Nashville is so well insulated. So
How big's the bump?
I don't know, man. 25. I'd say 25. Yeah. What do you think?
Last one.
I think it depends.
This year.
Yeah, that's a good point. This year. I would say that. Yeah.
I'm 50-50 on it.
Oh, really? Yeah. Okay. 25 or 50 or?
Oh, no, on an increase
bump
at all.
Oh, sorry. Side conversation. Grant's question was, how big is the bump on Wednesday? And he says 25. And he said, is it the last one? And I said this year, because it will be the last one this year. Anyway, is that about it?
Yeah, I'm still 50-50 on it. It's going to get increased or not right now. If
You
it
think
is,
it'll stay
maybe-
flat? I don't think it's going to go down.
No. I think he may do nothing. Powell may come out and say, I'm doing nothing here based on he's got a UAW strike going on. He's got $1.7 trillion of student loan debt that's about to be first payment due on October 1st. There's a lot of headwinds pushing him the opposite direction on that kind of stuff. Jobs have finally started to come down just a little bit, and what you have to pay is down just a little bit. So it feels like we're really close to the end,
I agree.
if not at the end of rate increases. And we're at what, 5.33% is the Fed funds rate right now.
That's effective.
And yeah, I'm pretty sure we said it'd be somewhere around 5.5 at the last.
If you didn't, somebody can fact check that, or we'll just go with that.
Yeah. Well, you watched it. What did we say?
Yeah, I don't remember.
I think we said mid fives at the high.
We
at the
did say
peak.
mid fives. Yeah.
Yeah.
I don't remember the exact.
What was the
number.
original question, by the way?
I have no idea.
Okay.
MSA.
Yeah, are we insulated?
Yeah. So, I mean, that is true of almost all Sunbelt states. If you look at Sunbelt states, which are majority, the state legislatures majority run by Republicans, they're low tax havens, they're high job growth, they are low property taxes, low to no income taxes. And so all of the higher tax states Midwest, Northeast, and West Coast are pushing this direction with either corporate headquarter relocations or arms of their businesses, or they're trying to find ways to move their lowest wage jobs to these states. And they may keep their corporate headquarters in California, but they're trying to move all their production, all their manufacturing to these states. And so given the amount of education and educated workforce that we have and skilled workforce that we have in Middle Tennessee, and the fact that we continue to grow that skilled workforce, I think we're in for a very long, sustained period of growth. It may be a little slower at times and it may be fast at times, but we are very well insulated compared to other cities that are our size in other states.
Awesome. Let's do this one. I'm going to end with that one. So let's do this one. Okay. Close your eyes, crystal ball. Rates finally drop. The pent-up demand starts to flow, right? We start to break that little log jam. We see resale houses hitting the market again, you know, in substantial numbers. Do we ever hit an actual equilibrium again, or do we absorb that pent-up demand? Does the inventory keep up? Do we see a massive spike in prices? Do we see, 3 years ago happen again where people go bananas? What does that look like when rates hit whatever that number is, 5.4 or 6.1 or whatever you guys say it is? When it finally happens, what does that look like, and how long does it take for us to even out? Do we even out?
I don't know that we do even out. Not in the foreseeable future. As far as you're talking about, like the equilibrium between buyers and sellers and like a flat market, I think this is as good a time for a buyer as you'll have in a long time. Just think about how many people bought houses from 2017 through 2021 and maybe the first half of 2022 who have grown their family. They bought a starter home. They thought they'd move up in 3 or 4, maybe 5 years, and now they've been putting that move up off, and maybe they've had another kid or two, and so they're busting at the seams, but they just cannot justify a move to the prices and the rates that we have now. And when rates get back to a number that they can justify, and they come flooding back to the market right now, new construction, we talked about it earlier, and new construction is really what's kind of keeping transactions flowing. New construction is always going to be there, but when those people are ready to sell their starter homes or their second homes and move up to the next homes, there's just going to be that much more demand out there in the market. And I don't know that there's enough, as populations are growing and continuing to grow, and people are continuing to move into Middle Tennessee. It's going to be a free for all again. And the first time home buyers might find themselves back in that kind of market where it's difficult for them to get traction, running offers that are at appraised value or lower, or not having any seller contingencies or seller concessions. So I don't think so.
Yeah, I think the comment that I would make is, nobody has a crystal ball, so it's impossible to know. But I think the rapid appreciation we saw from, let's call it, 2017, 18 to 21-ish, in that range. I think from an affordability standpoint, and I can only speak to Rutherford County because I know it better than the MSA, but I think when you look at the housing stock, Rutherford County has something like, or Murfreesboro has something like 46,000 units, if you will. And you look at how many people, 155,000 people live in the city limits. And so you start doing that math, and you start thinking about people, and you talk to people about affordability. How much does it cost to rent? How much does it cost to buy? I think the big jump in values over the past 5, 6, 7 years, I'm not sure that can happen again in the short term. And so as we're talking about saying, as we come out of this, will it just take off like a rocket? I'm not sure there's enough wage earners here that can afford another 10 or 15 or 20%, even if rates go down to 5%. I don't think they can afford the prices, right? So, I mean, that ultimately has a whole lot to do with that economics. But, in the overall MSA, I would lean towards we're probably going to come out very, very strong. But I would go back to that consumer confidence number, right? So if rates drop from 7% to 5% and consumer confidence goes to 99%, I don't know. I mean, that's gasoline on the fire and foot on the gas, and I don't know what that looks like. But I think the affordability piece is a big piece of that equation, and I don't think rates are going to fix that.
But we had that same conversation in 19. We had the same conversation in 20 and in 21 again.
That's a great point.
Yeah, so a lot of factors here. I think one of the things to think about is, Generation X is at their peak earning age right now. And Generation X was a fairly sizable generation, but Millennials generation is much bigger than Generation X. And they are now in the house buying age. They're getting married, having children, finally starting to have to buy houses. Some have bought 2 houses by now, but a lot of them haven't made their first purchase just yet. Behind them, Generation Z is even bigger than the Millennials, and they're the renter generation right now, which is partially why you see so many apartments under construction. Other reason was financing was easy, and they were deals that all institutions wanted to do at that time. So there's a huge population boom coming from folks who can purchase and want to purchase from the Millennials. And that's followed very closely by Generation X afterwards. That's going to put a lot of pressure on prices over the next 20 years if we don't build more housing stock. In the meantime, I think rates will stay up around 7 for the next 3 or 4 months, and then we'll see a slow fall. And once rates are under 6.5, I think buyers are back because they've been used to 7.1, 7.25. They're back at 6.5. And dear Lord, if they touch 5, just watch out. It's going to feel like it's 3 after you've been living in the 7s for so long. In 2020, right before rates dropped, they were hovering around 4.5%. So from 4.5% down to 2.5%, that 2% drop caused everybody and their brother to buy something. Well, if we go from 7.25 to 5.25, that's that same 2% drop. I think everybody will be back in the marketplace then. We will not have kept up with inventory, but what will come out with new housing inventory, but the shadow inventory will come on the marketplace. So those who have not listed because they don't think that they're going to be able to sell and buy what they want to buy. And I think the shadow inventory is pretty big. And so that's going to keep prices from skyrocketing immediately. I think we have something similar to what we had after the Great Recession, which was a period of 4 or 5 years of 3 to 5% growth in prices. I think that's what we're in for next until we get to the next squeeze point. And history bears that out. You can look back through prices in this country since 1900, and it's kind of slow, steady spike, plateau, slow, steady spike, plateau. We've gone through the spike. We are in the plateauing phase. Our year over year numbers are basically even Steven. And so we're probably back to slow, steady appreciation pretty soon.
I still have people talking to me about they want to wait till prices drop. We want to wait for, there's going to be another crush of foreclosures and things like that. Like I still have people telling me that. What do you say to folks that think that?
I like to ask them what they think is going to be the catalyst for that, and just see what their answer is, and then you can kind of have a conversation and maybe help educate them on why that's not likely to happen. There's no indicators that indicate a crash is coming, but you have to understand where they're coming from and their mentality and what they think is going to happen. If it's just blind optimism, and most of the time that's usually what it is. Just think it can't go up forever. But if you look at any of these charts that Grant's talked about, that's what real estate does. But yeah, to everything I think that we all know, there's in 2008 when we had the big crash, it was because people were upside down in their mortgages, and the lending and the building and everything was just loose and free and fast and cheap, and all of a sudden I've lost my job, and now we can't make it on my wife's job, and so we're upside down this mortgage. We can't even sell it for what it's worth. We just throw the keys to the bank and hope for a short sell at best. If that happened now, if the economy leads to a point where I don't close a single loan in 2024 and we're tired of leaning on my wife's income to pay our mortgage, we'll just sell the house. but even before we'd sell the house, honestly, I'd start bleeding a 401k. I'd start doing anything I could to keep my shelter and keep my residence. And so to me, there's when somebody has that kind of epiphany, it really helps them understand that there's no big massive bottom dropping out of the housing market. If people are like me in my mindset of, my kids and my wife and making sure we have shelter, that's our number one priority, shelter, food. I'm going to do anything I can to keep my house, because we're going to, if I sell it, we're going to go and start renting somewhere. I'm going to keep my house. I'm going to keep my house with my rate in the low 3s on my 15-year amortization, actually in the 2s with my 15-year amortization. And we're going to just stay put and ride it out.
Yeah.
Till I can start working again.
Trying to figure out how I'm going to answer this question. When people think about the housing bottom falling out of the housing market, they think of 2006 through 2010. That was the only real estate led recession ever in the history of this country. Typically it's either Wall Street leads it, or there's something else that leads it. This last one that we had 2020 was pandemic led, and it only lasted for 4 months. The Great Recession was real estate led from the subprime lending market. The subprime lending market really doesn't exist as it did because of the Dodd-Frank Act, making it very difficult to have these no doc, what do they call them, heartbeat loans. If you have a heartbeat, you could get one. So that stuff doesn't exist anymore. And then here's what gets into your psyche. I think you as the average American, me as the average American, even working in the real estate market at that time, what I didn't realize was, I knew the subprime market was pretty large. And I knew that was going to cause some pain at some point. But what I didn't know is that credit default swaps existed and that they were being traded on the scale and to the magnitude that they were. And so when the subprime paper went bad, you had these credit default swaps that paid off and would take down huge institutions. AIG was almost gone, which is incredible because they are a massive company. And so because we didn't know that, we think there's something we don't know now. And so you feel like, well, I didn't know that then, so there's probably something I don't know now.
Right.
Especially with all these old politicians doing crazy crap.
And that particular mindset has gotten even worse since 09 and 10.
Well, yeah, you were hurt badly.
The trust, yeah.
Right? You were hurt really badly in 06, 07, 08, 9, and 10. Like it cut you to the core. If you owned real estate, it hurt. Mm-hmm. It was hard to make payments on some of your rental properties that you had back then. And so that is being compounded, I think, by how we consume news nowadays with social media.
Yes.
The prevalence of conspiracy theories that aren't necessarily all conspiracy theories, but we go down those rabbit holes and some seem pretty, that could possibly be true. And so you think about what happened in these mortgage-backed securities, and then someone says, well, CMBS loans are next. You should wait and see. And you're like, oh, CMBS, I've heard that on Fox News or CNN. And yeah, that is next. And that's what they think, right? And so it's deep in our psyche. It's ingrained in us. That's causing, the fear, uncertainty, and doubt that we talked about last time. And so I can pretty confidently say, with the amount of oversight that we have now, with things like the Dodd-Frank Act, the transparency we have now into banks since a couple of banking collapses, now we're all hyper-focused on their balance sheets. There does not appear to be that crazy mechanism of subprime times credit default swaps times trading them millions of times across the world happening at this time.
Just think the guys that called the Big Short, they're buying real estate now. So
Water rights.
Yeah.
All right. Last question here. This is how we ended the last one before we went to questions from the audience. What are the opportunities right now? So in this market, as a buyer, as a seller, as an investor, whatever, where are the opportunities? If these folks in here are sitting on some money, sitting on some credit, whatever it is, what are the opportunities to be had in this particular climate?
I'll go first, but I think any operating business, and this is just from the overall banking environment, if you own a company and it's a service company or it's a widget company and you produce something, the banking environment is pretty warm to those opportunities. And so the primary reason for that is because we don't have lots of other things we're interested in doing. And so
You're bored.
Yeah, right. So if you own a business and you want to expand, it's a really good time to do that. We prefer, as bankers do, if you've got some underlying collateral, we don't want to lend unsecured. That's not what we do. But if you've got an existing business and a cash flowing business and a history of producing revenue, I think you'll find the operating environment pretty easy. If you are a investor and speculator, I would tell you that, I think there are always opportunities. All of that always, from my perspective, is time horizon based. So, even the comment, Brian, we were talking about, what is it? Date the rate, buy the house, date the rate kind of thing. I don't like it when I hear people say that, because I think it's somewhat nefarious in that they say, hey, I want you to buy a house because I need a paycheck, so please buy a house. But to be fair to those people that say that, if you're working with someone who's asked the question, how long do you plan to be in this house and what's your plan? As long as your time horizon is reasonable and you might not necessarily need to sell in 6 months or 12 months or 18 months, it's still probably pretty good advice, because, most mortgages are 7-year products. People are in a home for 7 years. That used to be the data. Do I think you're safe if you buy the house and date the rate for 7 years? Probably. You're probably pretty safe. But if you buy a house and you get a job transfer, you need to sell your house in 6 months or 12 months, I think that could be an issue. So, what opportunities are available? I think if your time horizon matches your investment strategy, then there are lots of opportunities. But from my perspective, operating businesses are really kind of the cream of the crop from the banking environment standpoint.
I think my advice is exactly the same as last time. It's patience and persistence. There's a lot more houses to look at. Most of the sellers are giving concessions of some kind. I think, again, the big opportunities lie with builders who have existing inventory. And if they are getting towards the end of the month, they've got to meet their inventory quotas, they are going to throw everything at you. That's rate buy downs, that's closing costs, that's upgrades, that's prepaid HOA. They will give away the farm to get that sale booked in that particular month. And so I think that's still where the big opportunities are. I think resale real estate still is not the place for the opportunity, unless you've got a death, divorce, or job loss. Probably only 1 in every 20 houses sells below market value on resales. But from builder standpoint, and they get to the end of the month, 9 times out of 10, they're giving away massive incentives. You may not get it in price, right? You may get $40,000 or $50,000 or $60,000 of value from them at the end of the month.
And to your earlier point, they can't give up price, because if they give up price on yours, it might be 6 weeks before they sell another one. They've shot themselves in the foot.
That's the great thing about buying in a community like that.
Mm-hmm. Awesome.
I continue to see opportunity now for the people who may have been marginally left out of the market the last several years. And so for the first time home buyers, there's a chance now to get a house and start the homeownership process. And we all have to start somewhere. Is the rate environment what you'd want to pay for your first home? No, it's not, but it's for a lot of people who are on their second or third home now, it's similar rates to what we bought our first houses at. And I don't want to go down the road of, well, how much did you pay for that house? Because I know it was a much lower number, but you have to start somewhere. And right now you have the opportunity to go under contract, and that's the name of the game. Home ownership requires a willing buyer and a willing seller. And if you don't have a lot of money, THDA rates continue to be priced below market. Sellers are still willing to help you out to protect their values with some closing costs and some concessions, rate buy downs. So take advantage of that opportunity. Take advantage of the ability to do something like our bounce back program, where you can refinance at a low cost down the road if the rate environment improves, and take advantage of the opportunity to start the homeownership process.
Good deal. All right. Open it up. Somebody out here have questions or specific things you want to ask about? Not all at once. Yes.
hearing about opportunities in getting a house. I think it was we've been looking around and not finding a lot of builders with inventory. I mean, maybe it's the kind of house we're looking for larger houses. Seeing different things, or what do you think I would be seeing? I'm a newcomer to the area, so
Yeah.
Grant, kind of restate the question also so we can get it online.
Yeah. So the question was, someone in Rutherford County is looking for a new construction house, slightly larger house than what the market typically has, and is having a hard time finding that house that's in inventory from a builder who's willing to give up the type of concessions that we just talked about. So one of my best friends is an area manager and president for one of the largest home builders in the country. And one of the interesting things that happened within that company over the last 2 years was they intentionally started building smaller. Same number of bedrooms, same number of bathrooms, same number of garage stalls, but they're building smaller. But they're charging the same price. And you see in the grocery store, they call it shrinkflation. The builders call it shrinkflation. So they didn't change their pricing, but they built smaller. And it appears that that particular company is going to continue building smaller because it has helped their profit margins quite a bit. So if you're looking at a larger house, you may not be looking at a national builder. You may be looking more at a regional or local builder. Local builders, if they were smart, did not start a lot of houses at the same time, but there's 4 or 5 that did. And so that patience and persistence, you will find that house probably this calendar year. You just don't know about it yet because they're sitting on it thinking, man, it's got to get a little bit better. It's going to get a little bit better. I don't want to put it out there just yet. It's going to get a little bit better. There will be an opportunity.
Right.
So, yeah,
And that goes back to what Ronnie was talking about, where, last year they might have come and said, hey, we want to build 10 houses right now. And Ronnie's saying, nah, let's pull that back down to 4 or 5. And, but I think looking in different areas, I tell people all the time, I can get you a great deal on something. I can get you something right now. Or I can get you exactly what you want. Right.
Can't have all 3.
But you can't have all 3.
Yeah.
So you can pick 2 usually. But I can't get you all 3.
I might find that inventory though if I'm looking at 2,000-3,000 square feet.
You'd absolutely find that inventory
100%.
if you're looking for that.
Or if you're looking for the bigger house in an area that is ripe with bigger houses, a Williamson County or something like that.
And we're not finding it there either.
Mm-hmm.
Neighborhoods of $3 million houses, they got nothing to show.
Yeah. Starting fewer specs for sure, and having downsized what they're building for sure. But in Williamson County, I mean, if you're looking in the Brentwood area, the average size of house has exploded. And it's remarkable how they've been able to sell that inventory. It's very counterintuitive. But you've got to assume that the top 3% of earners in the country are still going to be able to buy those houses. And that Brentwood is still desirable enough for them to be there. And the schools are still good enough for them to want to spend that extra money to be there and sort of live that Brentwood lifestyle. It's the same thing with Belmead, right? So Belmead really doesn't have anything going for it other than the fact that it's Belmead.
Right.
And their
Traffic
taxes
there
are
sucks.
higher. They have their own police force. They have their own town. They're their own city. They're within the Nashville MSA, but they're their own city. But man, I don't get it. You can go 4 blocks into Green Hills and buy the same house for $400,000 less.
But if you get arrested, you won't be in a Volkswagen Jetta.
No, you won't be. You won't be in a new hybrid Volkswagen Jetta.
Right.
Yeah. I think part of it too is you've got to work a little harder to find those opportunities because, builders are not motivated to put those listings out there in advance. And so, I've got guys that I do business with that, really until it's 99% complete, they're not even going to put it on the market. So You're not going to know about it on the MLS. The only way that you would run into it is if you drove by it. And so if, Nashville is a little different than Murfreesboro in the sense that there's a whole lot of tear down rebuild going on, whether it be Belmead, Westmead, Oak Hill, in Nashville, just kind of the Nashville MSA. And so people are going in and buying a desirable lot paying a lot of money for it, tearing the house down and then rebuilding a brand new structure. Most of the time, those houses don't come on the market until 30 days before they're completed. And so,
Or they're complete.
yeah, that's exactly right.
Yeah.
Because they don't want you to customize anything. If you want to customize it, sign a pre-sale, write a check, and then 18 months later, they'll deliver the house, or 12 to 18 months later, they'll deliver the house.
Yeah. Stackables. Yeah. Yeah.
Yeah.
No, that's pretty accurate.
Yeah.
The other thing I would tell you to watch for is I have seen significantly more houses fall through. So stuff is on the MLS, it goes under contract, 2 days, a week, whatever later, it's back on the market. And if that happens a time or two, sometimes that person's going to be significantly more negotiable, right? Yeah, I mean, you're seeing it all over the place.
In Rosebrook, right off the Sunset Road, which is probably the most expensive new development right now. They had a couple of them that fell apart. They were Creative Homes houses. One of them is now back, and then it went under contract. It's back, and now the price is starting to finally come down.
Yep.
$6.5 million, but it started at $7 million. Can't customize it. It's tough.
You can customize anything you want. All it takes is money.
You can get that. It's just going to be 12 or 18 months out. Yeah.
Some of those are pretty nice.
Yeah.
Just saying. All right. Other questions? Yeah. Art.
We're all experiencing a slower market. So as we're talking to our sellers, we're setting expectations for them. You guys have any suggestions as to how to more properly and honestly set up good expectations for our sellers in the market we're in right now, so that, because I've got listings that are like, well, what are we doing wrong? So nobody's looking like you're not doing anything wrong. It's just we're in a different market. Do you guys have any thoughts on better ways that we as realtors can just more properly set expectations for our sellers?
So the question is expectation management. Number one thing that a good realtor does, right, is set the expectation and then meet or exceed it. And Art's question was, what are the suggestions for setting those expectations, whether it's days on market, pricing, you're going to have to do a little bit of work on condition, those kinds of things that you might not have 2 years ago, maybe even when they bought it, right? They had to do all the fix-up work, and now you're telling them that they have to do the fix-up work again. Yeah, that's a difficult conversation. So, guys, suggestions?
I had a conversation yesterday, Friday, with a client, and it was this sort of conversation. And so this is going to sound pretty harsh, but I think the best advisors are very honest with you about things, and so they're not trying to make you feel great. Hopefully they don't hurt you in the conversation, because that's not the intent. But they give you candid feedback, and so I think interest expense matters when you're looking at profitability. And so if you've got a house that's sitting empty and you're on the meter, right, for it, then some real quick, easy math, 6 months, 12 months of operating expense and the uncertainty of what that looks like is a healthy exercise, and backing into what that price today looks like, right? The net present value of what that looks like is valuable. But I think to go back to the age-old emotion that everybody deals with in real estate, I mean, because that drives, our emotions drive a whole lot of what we do, right or wrong, it drives a lot of what we do. And so I think the expectation of having the honest conversation of, hey, look, is this your emotion speaking? Is this a fear-based conversation where if you don't have 6 months or 12 months of reserves to hold out before you sell this house, I'm going to tell you to lower the price. If you're not selling it, it's because the price is not right. And so we can argue that 3 months ago, the price would have been right. 12 months ago, the price would have been right. But today it's not. And so I would tell you that if you're not selling your house, it's not priced right. And so it's okay to disagree with that, because most people probably would. But if you've got the math to support an extended marketing period, 6, 12 months, 18 months, and that feels good to you, great. If the house is not selling, it's too high. It's listed too high. Is what I would say.
That's harsh.
Sorry.
So I go back a little bit to principles of psychology, and people remember extreme situations. They remember extreme good and extreme bad, and they forget reality. They forget what normalcy was. And they forget that in 2017, it took an average of 72 days to sell a house. And that felt really normal, and the market was appreciating. Everyone was happy. Consumer confidence was over 100 in 2017, 2018, and 2019. And so I ask people to forget about what they saw in the last 2 years. Forget all the stories you heard of your friends and your neighbors who listed their house, had 27 offers, and sold it for $100,000 over asking. It's an anomaly. It's not going to happen this time around. It may never happen like that ever again, where you're coming out of a pandemic of sitting on your butt doing nothing for 30 days or 60 days or however long, and then interest rates fell to next to nothing. And then all of a sudden you're like, well, what do I want to do? I want to get a new house so I have a better place to sit for the next 60 days, or I want that pool for sure. I mean, if you look at pools that have been built in the last 24 months and compare that to the prior decade, there are more built in the last 24 months than there were the previous decade together. It's insane. And so I always have this exact conversation with all of my sellers, and I don't end up getting all the listings because I tell them, listen, there is a price that the market will pay, and there is a price at which you want to sell. And that delta between those two determines your days on market and how long you're willing to sit and wait. And sometimes, even when you price it to where it should sell, even then, sometimes it won't sell because we are entering a slower period of the year where not as many transactions. At the beginning of school, hardly anything gets sold because everybody's concentrated on getting to school. Then you get a little bit of a bump in the rest of September, October, and then you're on the trajectory where it's going down. Then you got to wait until January before you get a bump, a little slowdown in February, and then you're back at it in March. And so I always tell sellers that if you miss one of those windows and you're still priced right, you could still sit. And it's not the fact that it's not marketed well. It's not the fact that the pictures aren't awesome. It's not the fact that, my sign's in the yard versus someone else's sign. It is just this reality of the situation. And you've got to forget about what you heard over the last 2 years. We're back to 2017. And if you remember what you were doing on September 18th at 7:30 p.m. in 2017, then you will remember that. But you don't. That's just the way the human mind works. So you just have to have that, that understanding, and you may not get every listing.
But you also have to mention that it is also entirely possible that we'll put your house on the market at the right price and it'll sell today. This is a volatile, changing market, and we don't know what somebody is sitting and waiting for. And there's a lot of sitting and waiting. There is zero sense of urgency on a buyer. And I think the other thing I like to mention that there's some psychology to it as well, with some strategy there. And I've had a ton of listings that go multiple this year that go multiple offers after the first price reduction. So it's listed and it sits price reduction. It almost doesn't matter what the price reduction is. And then that first price reduction happens and multiple offers. It's crazy because people are just waiting to see, are these people realistic or are they willing?
I think just having data too is important, so that when you go into that listing consultation or you're 30 days into that listing being live, just coming into that conversation with data that backs up what you're saying is important. So whereas before you didn't, as a realtor, you probably just say, hey, what number do you want? Okay, we'll throw it out there and we'll see what we get. Now you need to come into those conversations having done your homework, and you'll be glad that you did.
Good stuff.
My favorite listings are the ones where you go in there and you tell them, all right, you need to have the carpets clean. You need to paint this room. That highlighter yellow bonus room needs to be painted neutral. You got to weed. You got to do some mulching.
And you smell like cat.
Yeah, we got to have open houses. And the price is $500,000. And they say, well, you know what? I'm not doing any of that. And it's going to be $525,000. That still happens right now.
Oh, yeah.
All the time, because people think it's like it was over the last couple of years.
But then a buyer comes in and you'll get 6 offers right out the gate for 400.
Well, that's yeah. They'll lowball anything that looks like it's in distress. And so,
Right.
if you've got 15 different colors on your walls, people just assume you're in distress. I mean, like,
You probably are in
Yeah.
some kind of distress.
something's happening to this person.
That's the line of the night.
Yeah. Bless their hearts. All right. Other questions? Do we have any online, Trent? No? Okay. Anybody else? Yeah.
In the lending space, over the last 6 to 12 months, I've seen a large increase in folks who want to go into adjustable rate mortgages for commercial deals. In where the market is now, is that still sustainable? And is that a smart idea in this current environment?
I think it could be a smart idea if we just weren't in an inverted yield curve where it makes it just not that advantageous. And Ronnie knows a lot more of the metrics and the background of that than I could probably speak to. But from what I'm seeing in residential mortgage lending, there's just not enough investors out there who want that to really propel those rates to be lower than they should be on a 30-year fixed rate. Because if you compare the two, they're priced very similarly, and there's just not enough. There's not enough love from the investors to buy those arms. So we're just in theory, yes, but in what I'm seeing in the market, there's just not the motivation.
I totally agree with Brian. I don't think there is much upside to doing that. I mean, I think 6 months ago, there probably was some upside to doing that. The problem you get into is when you're staring really hard at a 7.5%, 8%, 8.5%, 9% fixed rate, and you can get an arm at a quarter or a half, even cheaper than that. You're thinking, why wouldn't I do that? It's just really unconventional, weird space right now. But I think the bigger question would be prepayment penalties versus not prepayment penalties because of the interest rate environment. So if you weren't paying prepayment penalties on deals before, especially for speculative real estate, you are today. And if your banker is not talking about it, you're either going to be surprised with it later because it's in your documents, or they're not paying attention. They're asleep at the wheel, some kind of thing, because nobody wants in 2 years, which is a reasonable period of time, to expect rates to have some relief from the interest rate pressure. And a lot of these rates won't be refinanced, right? And so, banks do not want to see 10, 20, 30, 40, 50% of their assets roll off at 8%, at an 8% handle to be repriced at 5% in a 12-month period. It'd be devastating to the financial institution. So we're building make whole clauses in those things where we know, hey, look, yeah, it's okay. You can pay it off, but we want ours from the standpoint that we thought when we made this opportunity, this loan to you, that we were going to have this loan on the books, this asset for this period of time, and we were going to earn X amount. They're going to try to carve in and grab as much of that guarantee return as they can because it hurts the business not to do it. But, it's a really hard time to be in my opinion, it's a really hard time to be making a decision about what's best. Yeah, I think you're flipping a coin on some of that stuff.
Agreed.
I have a question. So one of the things that I've started to see, and it may be the first time since 2009, since I got into the business, is there is a legitimate number of people that can actually now rent cheaper than they can buy and have the same house. How do you handle that? What is that when we're talking about objection handlers like Art was coming up with there? I mean, that's been our rally cry as realtors forever. It's cheaper to buy. It's cheaper to buy. It's cheaper to buy. And in some circumstances, that's not true anymore.
Well, if you're looking at dollar to dollar, yes, but if you're not looking at it over a long-term perspective at that point, then things like you're probably missing in that calculation mortgage interest deduction on your taxes. You're probably missing in that calculation potential appreciation over the next 3 to 5 years. You're probably missing in that equation what owning real estate does for you as a person in terms of building credit score, building your ability to be lent to, building. Look, the fastest way to become a millionaire in this country is through owning real estate. It may not be your primary residence at all times, but maybe your first home you buy is a less expensive rental property for someone to rent, and you yourself are a renter. but you start off buying something that maybe you wouldn't live in an area that maybe isn't where you live or work. So I have a hard time when people tell me, you know what, it's cheaper to buy or it's cheaper to rent than it is to buy. I keep telling them that that's not the whole calculation. There's a whole lot more to it than just the rental dollar amount versus the payment amount on your mortgage. There's a whole lot more to it.
I think a lot of people want to own homes, and a piece of advice that I give out a lot is, okay, so you're paying $1,300 a month in rent right now, and we know that when you go to buy a house, it's probably going to be a payment in the neighborhood of $2,000. And they're like, I just don't think I can do that. I tell them, well, save the difference. If you can save $700 a month over the next 6 months, then you'll know that you're going to be able to afford that payment, and it won't be a squeeze on your budget. If you can save even more than that, then great, because once you start taking on that $2,000 a month payment, you should be able to save in addition to that too. So if you do this for 6 months, two things are going to happen. One, you're not going to be worried about the payment shock to your budget, and two, you're going to have a little bit more money to come to the table with and make a larger down payment to help lower the payment.
Good. Other questions? Yes, sir.
Yeah, just want to put on commercial, you touched on it briefly, but what's the supply and demand balance there? I see retail still going up here, which I didn't see where I was living 7 weeks ago. Is that all being absorbed? I don't know about office space. I have no insight on that, but just roughly, quickly, what is that all about?
I would say that the banking environment in general is very red light-ish on commercial, and in some cases it's going to seem counterintuitive. Apartments and multifamily is still a very nice investment opportunity. Banks aren't interested. Mini warehouse is still a very attractive investment opportunity. Banks aren't interested. Nursing home facilities, post-COVID are a little tricky, but pre-COVID were really nice investments from a commercial investment space standpoint. We're not interested in doing any of that. And part of it is, the banking environment related to buckets of capital and how we get measured related to types of loans we make. And so without going into deep detail, whether you're examined by the FDIC, the State Banking Commission, Federal Reserve, we have these capital ratios. So for this type of loan, we have to have this much capital. For that type of loan, we have to have this much capital. And it's all based on historical loss rates, right? So if things get really bad, where your pressure point's going to be and how much damage can you take from a publicly, federally insured institution. So that's a short consolidation of that answer. But what that means is we're not going to take risk in those risky areas during uncertain times. And so even though there are some good opportunities out there still, we're just not going to take the risk because of the asset class, if you will. So I think you're going to see a lack of funding for those projects, and maybe from an economic standpoint, a lack of additional supply will help absorption of the existing supply so that some of those things work themselves out. But, we talk, not to get into politics, especially local politics, but we talk about here locally in Murfreesboro, all these big things we've talked about doing, Broad Street project, and you got several projects downtown, hundreds of millions of dollars. And we talk about those things as if, hey, it's coming and we're going to do this. No, that stuff's not happening. Just telling you it's not going to happen. They're not going to be able to do it because what the cost of capital, people would have to put 30, 40, 50% cash into those deals. And given the interest rate environment, if you can get 4%, 5% on your money in a bank, why are you going to try to get 10 or 12% and have tons of capital at risk to do something like that? Now, some people will, right? But when you can leverage, Grant mentioned this earlier, we were talking about private equity lending to builders. When you can borrow 80% of the money to fund a project, the economics of that are really nice. If you're having to fund 40% cash to do that, it's a different risk calculation, which is why, yeah, sure, banks are going to say, sure, we don't really want to. We'll lend you the money. It's a $100 million deal. You bring us $40 million cash to put in it. Keep another $10 million on deposit in the bank for reserves. So it costs you $50 million to borrow $50 million. No, that throws your pro forma way out of whack. Nobody wants to do that. So I don't know what state the economy is going to be in related to retail space, commercial space, warehouse, that kind of stuff. I think warehouse is probably a different ballgame. But I think there's going to be, for the next year, probably little to no demand from banks to do that. And so it may change the fundamental economics of those existing sites. It may make them more valuable. It may help them lease up better, those types of things. But I wouldn't expect to see much coming out of the ground. So,
Yeah, what I see in the retail space especially is those shadow anchored retail centers that have regional or national credit tenants that will sign a 10-year with 10-year renewables on the end of it. Those can get done using the equity funds, but I don't see anybody spec building a retail strip center expecting to put local credit tenants in there. And so from a retail standpoint, I think you'll see the regional and national credit tenants continue to find new spaces. As the population moves, they'll move with them. From an office standpoint, I don't know of a soul building an office building right now. I don't know of even the Oracle deal seems like it's in flux at the moment. I mean, they own the dirt, so they're pregnant, but I don't know that they're going to deliver the baby anytime soon. They're really slow walking that guy. And so it feels like that's going to be the story with office for a while, as people resist the call to come back to the office. And everybody's on these 2 or 3 day a week in the office, trial runs right now that are bumpy as hell, to say the least. I have another good buddy who's an office broker. All of his income he got for renewals, and you get prepaid that from some of these big companies. They're actually having to write checks back for commissions, pre-commissions earned on some of that stuff. And so, so that's very painful for these commercial brokers. So what they're trying to find is what are ways to repurpose this office space? Can it be converted? Is it in a part of the MSA that will allow it to be converted? Anywhere in Murfreesboro, I'm not so sure about the politics as I am at Nashville. But in Nashville, a lot of the times they don't want you to convert office space. It has an office space zoning, and they will not change it to a mixed use zoning. So you own an office building, you own an office building. And if it's not tenanted, then that's you. That's your problem to have.
What about short term, Grant? What's the short term market like right now?
Short term
to buy short term rental.
Oh, short term rentals.
Mm-hmm.
Softening, I think, is a good way to describe it. So Nashville had another record tourism year, broke all records again this past year, but has brought on quite a few new hotel rooms and quite a few new apartment buildings, which are not fully leased up. And so some of those apartment owners, big REITs and others, are converting some of their 1-bedroom stock into short-term rentals. And that's right down there in Nashville, like in the middle of downtown Nashville. And so that's eating into the short-term rental profits from the condo owners in that area. So I consider, I think there's still going to be weakness in the short-term rental market for a few years to come. A lot of it is based on rate. Some of it's based on income, but the incomes are still historically high on short-term rentals. So if you own a 4-bedroom townhome 2 miles from downtown Nashville, you're still grossing over $100,000 a year, which is crazy. I mean, that's a lot of money. It's down from $120,000 last year, but up from $90,000 in 2019. So we're still historically high there. It's just the cost of money is making it very difficult. And what you saw over the last 2 years are a lot of 1031 exchanges. And you don't see nearly as many 1031 exchanges where people are leaving high tax areas like Chicago and the West Coast and New York, and parts of Texas have really high property taxes too. And so they left and came here, but not seeing that nearly as much anymore.
Any other questions?
They're asking like very expensive, and but they're doing very well. still a lot of money and
Yeah, it's a great question. So in the space that I'm in the commercial banking space, we would back to these buckets and these asset classes. That's not classified as non-owner occupied real estate. And so that is a undesirable asset class for most commercial banks at this particular moment. And the reason is you're dependent upon someone else's operating income to pay you, not your operating income to pay you. So if it were a space where you were leasing it and you had your employees there and you were operating a business out of there,
that's the one, yeah. Looking to be the buy on already existing business,
Mhm.
doing very well.
Mhm.
I can start my own. You know, if I start my own, it costs less.
right?
He's asking very high price.
Yeah. So if you are going to occupy the space, and so this is tricky. Let's say there is, just to make the math easy, 1,000 square feet in this space. There are some measures that say as long as you are occupying 501 square feet, then you're owner occupied in classification. The other classification is, let's say you sign a lease, you own the building, and we have to figure out who owns it and how that's going to be structured. But let's say the principal and interest payment on that is $1,000 a month, right? If you sign a lease, your company signs a lease that you're going to pay $501, as long as you're paying more than 50% of the income, right, to go back and service the debt, then it can also be classified as owner occupied real estate. So I would say get with your banker and find out exactly how they're looking at that and measuring that to make sure that it can be in the owner occupied space, because you're going to have much more interest if it's owner occupied or can be classified as that. If it's non-owner occupied and you're just buying the space and you're going to figure it out afterwards, I would say there'd be very little interest in the market broadly. And if there was interest, they're going to invite you not to participate by saying, we'll do it if you put 50% down. So we don't want to be at a 60%, 65%, 70, 75%, 80, 85% advance rate. You didn't get any of that. It's going to be in that 50 to 60% would be my guess.
By building.
Okay, then I think as long as your tip over that 50%, either in revenue, lease payments, or in operating space, then yeah, you could probably get it done.
It's doing very well.
Hey, so this is where this, flips to where we're inviting you not to participate, to where we love you. We think you're the best. If you fit that owner occupied classification, you could probably do it for 15% down. So that's where 15%, if you're paying let's just say $1 million, put $150,000 down, the bank will finance $850,000.
This is not an
This is
offer
not a
for
commitment
credit.
letter. Yeah, this is not a commitment letter. Yeah. Yeah. Does that help? Sure. Yeah.
All right. Anybody else? Well, very good. Hey, thank you guys for coming out tonight. If you're watching at home, thank you for watching. If you're watching this later, thank you for watching it later as well. Thank you for Spread the Positive. Trent Denson over here taking time out of Monday Night Football to watch his Carolina Panthers and do this at the same time. So we appreciate you, Trent. And thank you for my lovely wife, Lisi, who found out at about 3:00 this afternoon that she was bartending. So appreciate you very much. And good to meet you guys, some new folks here. And thank you guys again for helping. We're gonna close out with this. You guys got like 1 minute each to kind of summarize where we are in the market, what you think's going to happen. Just kind of final thoughts.
I'm not as optimistic for rates to start their retreat in the first quarter of next year. I think it's going to be more towards the end of the second, start of the third quarter before we start to see a move towards lower rates. That's just my gut. It's just me looking at inflation. I don't care that it's an election year. I don't think that that's going to really play into what interest rates are going to do. And I think it's going to come down to more liquidity in the market for rates to move where we want them to be. And so until we see that institutional investor that has that appetite for mortgage-backed securities, rates are going to stay a little bit higher.
I'd like that we have some pain coming in the next few days with the UAW strike, maybe expanding with college loan payments resuming, with some delinquency on some car loans. I think that kind of data, even though it sounds terrible, it's good. It's music to Jerome Powell's ears. I'm a little more optimistic that rates will start to come down in Q1. I think some of the bond buyers may return to the marketplace, and it won't be because we've lowered the Fed funds rate. I think it's because the bond market is going to heat back up at the beginning of the year, as it typically does. With mortgage rates slightly dipping, hopefully that will cause a little resurgence there. I also think that we're stuck with these rates for a little while right now, but sellers are going to continue to be very resilient and not lower their prices. I don't think we have massive job loss coming anytime in the near future. I think the chances of a soft landing versus hard landing are going up slightly. That this may be a job-filled recession that we enter at some point. And I think we will have to enter a recession at some point. I don't think we can avoid that at all. And maybe the catalyst is some of the strikes that are happening and student loan payments. But generally speaking, I think that real estate is plateaued in terms of price, and we'll start to see a return to slow but steady appreciation over the next several years.
Yeah, I think the thing that I would continue to emphasize is make sure whether you're doing something personally for a primary residence, investment related, for commercial, for investments in business, make sure that you and the people that you're partnering with that are advising you, you're having very open conversations about timelines, what your plan is. It's who you do business with always matters. Having a relationship with the people that you do business with always matters. Lean on those experts, develop those relationships, make sure they understand what you're trying to accomplish in your business, because just buying or selling in this market with what's going on, I don't think is enough data to make great decisions. And so who you choose to partner with matters, and them understanding what your goals are individually for your business, for your family, really, really matters, because I think it could really change what you do and how you do it.
Amen on that. All right. Well, that wraps us up. We've got another class coming up October 2nd. Is that correct, Michelle? And it is a tax preparedness class for real estate tax preparedness. So we've got a couple of different experts that are going to be up here talking about how to get your taxes in order, get all that stuff together before the end of the year. So we're not going to have a tax class in January when it's too late. So we're excited about that. So if you want to come join us here at Cedar Glade Brews, we'd love to have you. Otherwise, if you want to join us online, you can do that as well. I guess that's it. Thank you for watching. Thank you for attending. My name is Jonathan Harmon with the J. Harmon Home Team of Keller Williams. We're here at Cedar Glade Brews. I got all kinds of fun stuff going on. So if you want to come join us, come join us. Thanks again.
Thanks, John.